Welcome to Explain the Charts, where today we are diving into a high-stakes analysis of the AUDUSD currency pair. The current date is March 23, 2026, and the markets are reacting sharply to escalating geopolitical tensions in the Middle East. Looking at the current events, the Australian dollar is under significant pressure as growth fears fuel a sell-off in Asian currencies. A major driver today is the report that President Trump has issued a 48-hour ultimatum to Iran regarding the opening of the Strait of Hormuz. This news has triggered a risk-off mood globally, which historically leads to a weaker Australian dollar against the safe-haven US dollar. Simultaneously, we have a hawkish Reserve Bank of Australia that recently hiked rates to 4.1%, the highest in the G10. However, even with the RBA suggesting another hike to 4.35% might be coming in May, the currency is struggling. The market is currently weighing these supportive domestic fundamentals against the massive threat of a regional conflict and rising oil prices. Interestingly, the correlation between AUD and crude oil has turned sharply negative at -0.75, which is an unusual but critical metric to watch. As we open the daily chart, we can see how this fundamental backdrop is translating into price action. On the daily chart, the overall trend since late 2024 has been a gradual recovery, with price climbing from the 0.62 level up toward the 0.71 range. However, looking at the recent candles in early March 2026, we see the pair was rejected at the 2023 high of approximately 0.7191. This rejection created a shooting star formation, which news reports highlighted as a potential signal for a fatigued rally. Since hitting those yearly highs, the AUDUSD has been consolidating within a range between 0.6950 and 0.7150. The latest daily candle for March 22 closed at 0.7009, but today's early trading shows a gap down towards 0.6957. This break below 0.7000 is psychologically significant and suggests that the risk-off sentiment is winning the tug-of-war. If we look at the support levels, the 0.6950 zone is the immediate line in the sand for bulls to hold the current structure. A failure here would likely trigger a deeper pullback toward the 0.6900 level, which analysts identify as a trigger for a risk-off cascade. The 50-day exponential moving average is currently acting as a soft support, but its strength is being tested by the Iran news. Bulls need a decisive reversal or a de-escalation in the Middle East to regain the momentum required to challenge 0.7140 again. Switching over to the 1-hour chart, we can gain a clearer perspective on the volatility that has defined the month of March. Notice the sharp drop-offs on March 3 and March 12, where price faced aggressive selling pressure each time it approached 0.7120. The hourly data reveals a series of lower highs, indicating that the bearish pressure has been building for several weeks. The candles on March 18 showed an attempt to stabilize around 0.7100, but that level quickly turned from support into resistance. As the news of the Strait of Hormuz ultimatum hit the wires, we saw a steady decline in the hourly candles through the late-week session. Currently, we are seeing the market cluster around the 0.7010 to 0.7050 range, with very little follow-through on the upside. The transaction volume has been relatively high during these drops, suggesting that institutional players are hedging their positions. Options markets are also showing a bearish skew, with increased demand for downside protection via put options. This technical weakness on the 1-hour timeframe suggests that the path of least resistance remains to the downside in the short term. We should look for any hourly close below 0.6980 as a sign that the next leg down is commencing. Now, let's zoom in even further to the 15-minute chart to see the immediate reaction leading into today's session. The data from March 18 to March 22 shows a clear descending channel that the pair has been trapped in. Every attempt to rally back above 0.7110 was met with a swift rejection, forming a very consistent ceiling. By the time we reached the late hours of March 22, the pair was barely hanging onto the 0.7009 level. The 15-minute candles show a lack of dip buying interest, which is a bearish sign in a risk-off environment. This microtrend confirms that traders are avoiding the Aussie as a liquid proxy for Chinese growth fears. If price cannot reclaim the 0.7030 level on this timeframe, the bearish momentum will likely accelerate. Keep a close eye on the volume during the London and New York opens today, as they will likely dictate the break of the current range. Returning to the daily view, let's recap the critical levels you need to watch for your trades. The most vital resistance levels are 0.7140 and the major psychological barrier at 0.7200. On the support side, 0.6950 is the immediate floor, followed by the high alert zone at 0.6900. For a bullish outlook, we would need to see a confirmed daily close back above 0.7100 accompanied by a de-escalation in geopolitical tensions. The likelihood of a bullish reversal in the next 48 hours is currently low, perhaps around 30%, given the severity of the Trump ultimatum. Conversely, the bearish case has a higher probability of roughly 70% if the 48-hour deadline passes without a resolution. A breakdown below 0.6900 could target the 0.6840 level quickly as stop losses from long-term speculators are triggered. Remember that the RBA's hawkish stance provides a structural floor, but it may not be enough to offset a full-scale regional conflict. Keep watching the news regarding the Indian tanker reports and any strikes near Diego Garcia, as these will cause instant spikes in volatility. Trading during these times requires strict risk management and smaller position sizes due to the potential for massive gaps. This analysis is for educational purposes only and does not constitute financial advice. Always do your own research before trading. Thank you for watching Explain the Charts, and we will see you in the next market update.